Good afternoon, everyone. I'm Nancy Alexander with the Heinrich Boll Foundation, and the Heinrich Boll Foundation is co-sponsoring a day with Earth Action, and this particular session is being sponsored by the Forum on Democracy and Trade, the Center for Economic and Policy Research, and Citizens Trade Campaign. And it asks basically about what the prospects for change are in Obama's international economic diplomacy. And it asks some pretty key questions. Has the current economic crisis impacted how developing countries think about finance and trade? If the current crisis was partly triggered by radical financial deregulation and the shrinking of national policy space through new trade commitments, why are world leaders intent on signing more agreements and finishing the Doha round of World Trade Organization talks? What are the implications of a massive recapitalization of the International Monetary Fund? For those of you that reviewed the outcome of the London Summit in April, the London Summit, which was comprised of the group of 20 countries and several others in addition to the 20, the London Summit stipulated that the IMF's resources should be almost tripled. And so some of the events today have been asking the question, should the IMF get this massive recapitalization without, at the same time, or before getting this recapitalization, having a more democratic governance structure, greater transparency, greater accountability. The session also asks, what are the prospects for countries in Latin America to pursue alternatives to the IMF and free trade agreement policies? And our keynote presentation by Mark Weisbrot, who I'll introduce in a minute, is going to be followed by a panel where we'll have an opportunity to delve even more deeply into these kinds of questions. And a lot of you have been around for a long time and really don't need basic reminders about what powers these institutions have. And there's been a lot of conversation today about the International Monetary Fund. And I just want to say one thing, and Mark may enlarge on this in his presentation, that people should remember when we discuss the IMF, and that is that it is head of a financial cartel. And what does that mean? That means that when a country is not in compliance with the targets that the IMF sets for it with respect to fiscal deficits, inflation, monetary policy, and so on, then it is, in the language of the fund, that country is off track. Now, what does off track mean? Off track means that the IMF is basically giving a black mark to the country. And when that happens, a whole sequence of events happens. And that is that not only government donors, who are very critical to especially the poor countries, 2/3 of all the official development assistance that's received by poor countries is in the form of official development assistance that comes from governments, especially European governments, but also U.S. Agency for International Development, as well as the concessional arms of both the IMF and the World Bank. And the IMF's concessional arm is the Poverty Reduction and Growth Facility. It was renamed with these words poverty in it. And the World Bank's concessional facility is called the International Development Association. So low-income countries are extremely dependent upon the rating that they get from the IMF. Middle-income countries that had access or have usually had access to world markets, if they get a bad grade, then private finance withdraws from their countries. And so basically, this is a financial cartel. And so when people talk about the conditions of the IMF, they're referring to conditions that must be met for money to flow. So since we've said a lot about the IMF, that's a basic, and Mark will give us a much deeper and broader picture. And Mark has received his PhD in economics from the University of Michigan. He is co-author with Dean Baker of Social Security, The Phony Crisis, and has written numerous research papers on economic policy. He writes a column on economic and policy issues that's distributed to over 550 newspapers by the McClatchy Tribune Information Services. His opinion pieces have appeared in the Washington Post, the Los Angeles Times, the Boston Globe, and most major newspapers. And I especially want to commend to you the wide swath of papers that the Center for Economic and Policy Research have displayed on the table outside, and draw your attention to one: empowering the IMF, should reform be a requirement for increasing the fund's resources. Another, IMF voting shares, no plans for significant changes, and many others that are deserving of your attention. And with that, I turn you over to Mark, who is co-director of the center, and he'll be speaking on the global economic crisis and its implications for developing countries. There could be no better person to hear this story from. I give you Mark.
Thanks, Nancy, for the kind introduction. I thought I was going to have to wait till I was dead to hear anybody say anything that nice about me. And Nancy herself is one of the leading experts on these institutions in this town, and has been waging a valiant struggle for reform for at least the last decade that I can remember. And so I'm very thankful to her and to Peter Reyes and the Forum on Democracy and Trade and everybody who helped organize this event and the series of events. So I was asked to give an overview, a little bit of an overview of the global economic recession and its effect on developing countries, and then something about the IMF that has to do with that. And I don't know what everybody's discussed previously, so I'll try not to overlap too much, but there will be questions, lots of time for you to follow up on any details. And of course, more details can be found on our website at cepr.net. So in terms of the overview, there's a short-term and a long-term story. And so I'll try and do a little bit of both. In the long-term story that the crisis or the recession is part of, is a long-term development failure in the world, in the vast majority of countries in the world. You've seen over the last almost 30 years now, in the vast majority of countries, you've seen a sharp slowdown in economic growth. And you've seen that also going along with that, you have a reduction in progress, in the rate of progress on social indicators such as infant and child mortality, education, life expectancy. Now again, this is this is adjusting for the fact that you can't see the same rate of progress over time. There's something called diminishing returns, for example, of life expectancy. It's not as easy to go from a life expectancy of 70 to 75 in your country as it is to go from 50 to 55. But if you adjust for that and you look at the last 3 decades, and again, you look at all the social indicators for which we have data, and you look at the rate of economic growth and adjust for diminishing returns there as well, you find there's been a drastic slowdown. That's a long-term economic failure. And again, it's not all the countries in the world. There are a few exceptions, and they're big ones, like China and India. They contain a lot of people. But the relevant variable here is the number of countries, right? Because if you have basically an experiment over the last 30 years where a whole set of new policies were tried, and they were tried in 80 to 100 countries to varying degrees, and a handful of them did better, just a very few, a literal handful, and the rest did vastly worse. And you can, if you look at the countries like China or India or Vietnam or Korea that actually had a recession, you find that they were the ones that did not implement the policy changes that most of the rest of the world did. And those are problems that they're generally referred to in the rest of the world, these policy changes, as neoliberal policies. And I don't have time to go through them all, but basically they have to do with the opening up of deregulation of international financial flows, the opening up, indiscriminate opening up of trade, the narrowing of policy space that other people have talked about. In other words, the basic abandonment of development strategies that have been successful in the past. Some unsuccessful, but mostly successful ones have been abandoned. And privatizations and a lot of labor market reforms as well, which affect the distribution too. So that's the context, and I'm only giving you this context in 1 minute quickly, because what this particular recession is, this recession is related to those reforms, only it started, unlike the other crises that we've had in recent decades. This one, there's been many financial crises, currency crises, but this one started in the rich countries, and particularly in the United States, as the epicenter of this one. So this one was different, but I would argue that it's still part of the overall pattern of neoliberal changes. Okay, that said, now we go to the short-term story, and we maybe come back to the long-term as there is interest, the long-term policy changes. So the short-term story is, first, that the reason I use the word world recession instead of financial crisis, well, the word crisis is kind of overused. To me, a crisis is like, what they had in Argentina in 2001, when 5 presidents resigned within a few weeks. So in a lot of ways, this isn't a crisis. I think it's a little bit overused because, we could be in this recession for years, and Obama might even get reelected in 2012, even if everything is still messed up. He might not, but he might. So I would call it a severe recession, and it's a global recession. And that's not to trivialize it. It's the worst recession, as everybody knows, since the Great Depression. But more importantly, I'm not using the word financial crisis because I don't think it's primarily financial. And we've written about this quite a bit at CEPR. In fact, the overwhelming aspect of this recession is the real economy. That is, the declines you're looking around, you see in the United States, but also in most of the world, are overwhelmingly due to a decline in the real economy. So let me start just briefly with the U.S. to show that. The U.S. is nearly a quarter of the world's economy, and so it affects the other countries. So if Mexico, for example, is going to have, projected to have a decline of 7.3% this year, which is huge, one of the bigger ones in the world, and certainly in this hemisphere, it's because they're dependent primarily, overwhelmingly on trade with the United States. Around 80%, 75% of their trade is with the United States. And trade is a large part of their economy, maybe 37% of their economy. On that basis, they're having a huge decline. It really doesn't have all that much to do with the financial system, even in Mexico, and much less in the United States itself, which is the cause of the Mexican slowdown. So I want to emphasize that it's widely misunderstood. Almost everything I read in the media is about the financial crisis. And that really is a not very accurate, I would say inaccurate description for what is happening. So in the United States, the epicenter of the storm, the main cause of this recession, our recession, is the bursting of an $8 trillion housing bubble. And that peaked in 2006, and it was quite obvious. We began, my colleague Dean Baker began writing about it in 2002. And it should have been obvious to a lot of people. In fact, he's still writing about all the people who should be fired for not having noticed the biggest asset bubble in the history of the world. And that would include some people at the IMF as well, but also the Federal Reserve and everywhere else. And so that was the main cause. And this, again, you don't see the word bubble very much in the press. But you could abstract out all the problems in the financial system. In other words, say that they were all solved tomorrow. All the toxic assets and everything else. And you would not be facing a drastically different situation in the United States, because the bursting of that bubble has a wealth effect, what economists call wealth effect, and that is people cut back on their spending. And the construction center, which reached about 6.5% of GDP at its peak and goes down to 2.7 or so now, that is also another huge shock to the economy. And so those shocks combined with other housing-related sectors would be enough to give us the worst recession since the Great Depression, without any problems in the financial system, secondary problems whatsoever. Now, that's not to say that the deregulation didn't make it worse and all the subprime mortgages and everything else. But again, this is primary. The other stuff is big or sizable, but secondary, very secondary. And that's very important to understand. And there's a million ways I can show you that, but I hope you'll take it at face value and ask questions if you want. I don't want to spend the whole time on that. Now, what does that mean? Well, that means that the biggest impact on the rest of the world is also through most of the rest of the world is through the real economy, which is trade. So Japan, for example, is going to decline 6%, projected decline is 6% this year, after a 0.7% decline last year. That's because of trade, heavily dependent on trade. Europe is going to do worse than the United States. The projection for the United States after 1.1% growth last year is 2.6 negative this year, whereas for the euro area, projecting negative 4.8 for this year. Now, that's partly also for a couple of other reasons. One is that they're not pursuing the kind of stimulus policy that even our enacted stimulus is in the United States. As I mentioned, Mexico was negative 7.3. For this year, but Brazil is only negative 1.3. Why? Brazil has, not even a third of the trade with overall that Mexico has, and the trade with the United States is maybe not even 1% of GDP. So again, the transmission mechanism is through the real economy, but it hurts nonetheless. You see declines. So that's one of the main impacts on the developing world. Now, very interestingly, China will also slow, but it's only projected to slow from 9% last year to 7.5%. Even though they do have quite a bit of trade, as you know. Now, why is that? Well, China is not it's a semi-planned economy. I mean, 20% of GDP, which is more than all the investment we have in the United States, is state-owned investment. The banking system is mostly state-owned. So when China wants to switch their priorities, as they did in the last crisis during the Asian financial crisis, they can switch a lot of their priorities, and they can adapt much more better to to the loss of export markets than other countries that are heavily dependent on trade. And they do it so, and as a result, they're also roughly the second largest economy in the world, so they will have a major impact on the region. and hopefully enable Asia to recover in spite of the U.S. U.S. lagging. The U.S., again, I'm speaking mainly on developing countries, so I don't want to focus much on this, but because it does have a big impact, it is important. I think the United States is still in a lot of trouble, and we have a little on our website at CEQA, we have an honorable economist that have called for a third stimulus because the last one was quite inadequate. It really amounts to, not even 1% of GDP if you knock off the cuts in state and local government spending and tax increases. You've got a very small stimulus for 2009 and 2010. And the last economist that we added to the list was, to his credit, Olivier Blanchard, the chief economist of the IMF, who announced this last week that countries should be looking to another stimulus. It's the rich countries, of course, and I'm going to get to that in a minute. So because the United States is until the United States adopts another stimulus and a large one, we don't expect any sustained recovery. You could have a positive quarter, some uptick, but not a sustained recovery for the United States. So far, President Obama is still against another stimulus, but I suspect that he will change his mind as time goes on and the 2010 elections get closer. So that's the, in terms of the overview, Africa has been hit very hard. Mainly, again, another transmission mechanism, which I haven't mentioned, is commodity prices. And unfortunately, those were affected very much by speculation, both on the upswing and on the downswing. They've recovered a lot this year, so I think Africa will be better off for that. But their growth slowed from 6% to 1.5% from 2008 to 2009, so they were very hard hit. Latin America is not projected to be hit, they actually are projected to be hit fairly hard, but again, it really varies by country. Their projected growth is negative 2.6 for this year, but I have to also qualify that these are the IMF projections I'm using, and they've been wrong about Latin America many times for many years, and usually in that direction. Now, what about the developing countries? And I haven't even talked about the human cost. There are various estimates in terms of the increase in unemployment, the increase in poverty rates. It's in the tens of millions, maybe 100 million, maybe over 100 million for poverty in the world. And this is obviously a huge impact. And many people, including the people at the UN Commission that Stiglitz headed, President Lula da Silva of Brazil, had pointed out repeatedly that this is particularly unjust because the developing countries were not the source of this crisis. It really is the epicenters in the United States and the other rich countries. And so that's very important to keep in mind. Now, and I think it's, the UN Council the Stiglitz Commission has made a very strong case that the United Nations should be the center of reform efforts for the global economic system going forward. But unfortunately for us, the power, the financial cartel that Nancy described in her introduction still belongs to the U.S. Treasury Department, and they don't intend to give that up at all. In fact, we had a huge battle in Congress. Has anybody talked about this already, or should I give a couple of details?
Details.
So we had a big battle in Congress in the last month to try and attach some reforms to the $108 billion that Congress approved for the IMF. And we mostly failed. There was some language that came out of the conference report that included things that we wanted. And I'll get to that in a minute. But the point is, we were trying to attach some language that would prevent the IMF from some of its worst abuses. And this has always been our strategy at CEPR for the last 10 years, and beyond, before that, before we formed CEPR. We call it harm reduction in dealing with these powerful institutions. That is, you try to reduce the harm that they do, even though you're also trying to reform them and get them to do good things. You have to recognize that over the long term, the most powerful impact that non-governmental organizations can have, I should say, in the foreseeable future, not necessarily in the long term, is to reduce the harm that they cause, because they can do enormous damage. And so our efforts were, this was a harm reduction effort, to attach conditions. First of all, to say that they can't ask governments to cut healthcare and education spending, for example. To say that they can't impose contractionary, or what Commons call pro-cyclical economic policies, macroeconomic policies, that is, cutting spending, raising taxes, raising interest rates, cutting the real money supply, that they shouldn't be allowed to do that in countries that had, say, less than 2% growth over the last year. And then some democracy reforms that they're agreeing to be passed by parliaments, which also limit some of the more abusive agreements. And in the bill that passed, well, it was an interesting battle because the Obama administration attached the spending to the war spending bill, the war supplemental, I should say, or appropriations. And they got it passed, but it was a real fight. I mean, the groups are working on it, and I have to give a lot of credit to a lot of groups, especially the peace organizations who were against the supplemental, not only because of the IMF spending, but also because of the wars. And they managed to get 32 Democrats to hold their ground. The Republicans voted against because they didn't want the IMF money on the war spending bill. But it squeaked by with 3 votes, and they got it. But it took quite a fight, and it shows that people can actually have some influence. And then in the report language, they did include some of the language in the conference report. And then President Obama issued a signing statement where he basically said that the administration was not bound by any of this language. And Congress rebelled, and they voted, what was the vote? 400 to 3 to say that, no, this language is our input, and you don't have the right to, you, the executive branch, do not have the right to sign Congress out of the picture. So there's still hope for reform, I think, going forward, to limiting them. It's going to be a long battle, but every year at least, we have a chance in Congress to limit them, and I think, it's not as dismal as you might think. I mean, the reason they got this passed, they had to do quite a bit to get it passed. They had to attach it to the supplemental appropriations bill and tell everybody that if you don't vote for this, you're going to get paid that's being against the troops. They had to pull out all the stops. They had to threaten many Democrats with many evil things. They had to do quite a bit, and it's the hardest battle they had. And they got it also because Obama is still on a honeymoon, and many Democrats who know exactly what the IMF does and are very in favor of these reforms didn't vote against it because they didn't want to go against Obama because he made a commitment to the G8 and all that stuff. So those were very, so again, you can't look at this and think that this battle is over at all. That's just a little over that struggle which continues. Now, what about the developing countries and the crisis in the IMF and macroeconomic policy? That's what I'll talk about until I stop, which won't be very long. And if you notice, I said that the IMF, including their chief economist, has now even come out, the chief economist has come out for a third stimulus. The IMF has, from the beginning of this recession, which started in the United States in December of 2007, has called for a big fiscal stimulus and even expansionary monetary policy as well. But the call has been limited to the rich countries. So this is the double standard that I'm talking about. And this is the thing that we have to fix. Because it is possible for developing countries also to pursue stimulus policy. And there are a whole number of countries in Latin America that are doing so, and you will see that they will come out of this crisis, for example, better than the others. And China is another example. They have one of the biggest stimulus programs in the world. It's much bigger than ours as a percentage of their economy. And they also, I think that's part of the reason they're not doing as badly as other countries. So why does the IMF do this? And what is their position? First, let's make their position clear, because they do fudge that quite a bit. You know, we had a debate with them just recently where they tried to say, no, we're not doing this. Well, in the agreements that they have, we're still going through all 50 of them, but the overwhelming majority of them have some kind of pro-cyclical policy. That is, policy that will make the economy slow or worse, or it's in recession, make the recession worse. And that would include reducing the fiscal deficit, which could be either cutting spending or raising taxes. That would include raising interest rates, and that would include shrinking the real money supply. In the countries that have, standby or other short-term arrangements that have this, they include El Salvador, Pakistan, Ukraine, Turkey, Latvia, Hungary, Belarus, Serbia, and Armenia. Those are just the ones that we looked at that have these kinds of policies. But in the poorer countries, it's about half of the current agreements also have pro-cyclical policies. And in many cases, and I would say in almost all these cases, really it's unnecessary. Now, what is the argument? The IMF has an argument. Their argument is that the rich countries can afford to have stimulus policies because they either can borrow domestically without causing too much inflation, or they can borrow internationally on the current account if they, and/or I should say, they can borrow internationally. In the United States case, of course, the rest of the world is using the dollar, so we don't even have a problem. We're running a huge current account deficits if we want to. But even in other countries that have hard currencies, the Euro area, Japan, they also they don't have the problem that they're going to they can print money, like we've done. The Fed has created over $1 trillion in new money since this recession began. So what they're arguing is two things. One, that the developing countries have a constraint that the rich countries don't have. Namely, they have to have enough international reserves to be able to guarantee their banking system and to carry on a normal trade. And if they go below a certain amount, they have a crisis. Okay? Now, what does that have to do with stimulating the economy? Well, it so happens that if you stimulate your economy, one of the things that happens is you grow faster than you otherwise would, and if you grow faster, you import more. And so that all other things being equal will reduce your trade balance and your current account balance. And if you're running a current account deficit, as many of these countries are, that means that it gets worse, and you start to eat up reserves. So that's their basic story. There are a couple other stories that go with it. I mean, in Eastern Europe, for instance, they'll argue that Latvia, Estonia, Lithuania, they have currencies that are pegged to the euro, and they don't want to undermine confidence in the peg, so those countries have to bear an even higher price. It's very similar to what they did in Argentina from 1998 until the currency collapsed at the end of 2001. And they did a similar thing in Brazil and in Russia. And you can see historically that was completely wrong. In every one of these countries, they went through recessions of some sort, some terrible, like Argentina. The currency collapsed anyway, and then they began their recovery. So it was wrong. But that is one thing that you can't do as a matter of economics, If you have a current account deficit and you want to reduce it, one way you can reduce it is by shrinking the economy. And I should say we're doing that right now in the United States quite efficiently, not deliberately, but the recession has brought our current account was around 7% of GDP at peak, and it's now down to 3.2 year-over-year basis, which is quite a big drop. Now, unfortunately for us, because of the structural problems in our trade deficit, it's going to shoot way back up. Unless we actually get the dollar down and keep it there, it'll shoot way back up when the recovery starts. But nonetheless, you can see how this process works. So that's kind of the IMF story. Now, what's wrong with the story? Well, the biggest thing that's wrong with the story is that that's what they're supposed to be there for, is to provide the hard currency so that these countries can, most of them at least, do the same thing that we're doing, which is to stimulate their economy in a recession instead of shrinking. Okay? So that's the number one thing that's wrong with it. And I'll admit that there are borderline cases. There are cases where the current account has gone so huge that the country can't do what we do. Although, it really depends. I mean, if the IMF is willing to put up some serious money, they can do it. Look at Mexico, for example. The IMF has provided $48 billion in their FCL, flexible credit line. And the U.S. Federal Reserve has provided another $30 billion. That's a lot of credit. So Mexico, I think, doesn't really have to worry about a run on the peso. Doesn't have to worry about a banking system collapse that would be caused by, the sudden or too large a depletion of their reserves like we had in 1995. But, so if they want to put up the money, and unfortunately the flexible credit line from the IMF has only been available to Mexico, Colombia, and Poland. So you have to be a right-wing government with a very special relationship with the United States, seems to be the only requirement for the FCL. If they were to do that for other countries, and you have to remember also that a lot of countries, look at the poorest countries in the world, what are they going to borrow from the U.S. to back from the IMF to back the banking system? It would be very, very little. And so they could save a lot of countries. They could rescue a lot of countries instead of squeezing them. And that's what's really wrong. And I don't have to, I don't want to go into the whole history of what they've done, but they do have a 30-year history of doing this. Okay, I think I've covered the overview. And we have time for questions, so I can go into detail. The only last point I want to make is how important this IMF story is to the overall world economy. Because obviously the countries that are independent of the IMF, like China or Vietnam or India and most of Latin America, most of the middle-income Asian countries, they're going to do what they want and they're not going to be affected. But the problem is that there are still 50 agreements out there in the world that the IMF has. Some of them will be renewed. And the IMF is getting an infusion of money that it's never had before in its entire existence, never come close to this, even relative to the world GDP. It's hundreds of billions of dollars. So this is an attempt by the U.S. Treasury Department and the European Union, which is their ally, all these in Japan too, to a lesser extent, but still enough so that they're willing to kick in $100 billion, to revive this institution that had lost most of its influence in the world over the last decade. And that loss of its influence over the last decade, I think, in my opinion, is the most important and positive change in the international financial system that's taken place. It's the most important change that's taken place since the collapse of the Bretton Woods system in 1973. So they're trying a major reversal. And they won't get most of it. Like most of the middle-income countries will never go to the IMF again, no matter what. But they will increase their power and influence. And since they haven't changed their economics, that's a bad thing. That's got to be a bad thing. So that's going to be a big struggle in the ensuing years. It's not anywhere near as bad as it looks if you just look at the dollar amounts that they're getting. But it's still a very important problem going forward. Okay, I'll leave it there for questions. Thank you.